When you're young and money is scarce, saving for retirement is probably the last thing on your mind. You might make the assumption that once you get your dream job you'll be able to make up for lost time and money, but the truth is you'll end up spending more to save less in the long run. It's so important to investing in a savings account from a young age. Did you know that sacrificing beer and pizza money during your college years will yield over $100,000 more in returns on investment over the course of a lifetime compared to the savings account of someone who started investing in his late 20s? Not only does the young investor end up with a 7-digit bankroll by the age of 65, but he also invested much less throughout his lifetime than his late-to-the-game counterpart. In fact, by the time the latter had started investing, our young hero found himself able to sit back and watch the dividends roll in without putting another penny of his own money into the equation. In this video, I will explain how saving early not only builds a strong financial foundation for your life, but it also builds a foundation for the way in which to live your life. If you want to be successful, stay prudent in all areas, and think about the consequences of every decision you make before taking the first step. Investing, as with anything in life, benefits from an early start. The earlier you begin planning for retirement, the greater your potential return on investment. This holds true for everyone. By taking advantage of your youth, you can get a head start on saving for your future. However, if you're not sure about the benefits of early investing, here are 5 reasons why it's best to start sooner than later. 1. Time allows you to take risks. Typically, when it comes to investing, ventures that are more volatile yield the highest return on investment. Investors, who have the time to recover if something were to go wrong, have the opportunity to make riskier moves. Those who begin to invest late in life are often inherently more cautious with how they invest their money. 2. Compound interest really makes a difference. Essentially, compound interest is the interest earned on interest. By continuously reinvesting your earnings, you are exponentially increasing your return on investment. Savvy investors understand the benefits of investing early and taking advantage of the potential gains from compound interest. To help you understand how time and compound interest are related, here's an example. 25-year-old Madison invests $2,000 annually over 10 years in her company's 401k, with an average growth of 10%. When she retires, at the age of 65, her investment would have grown to $556,197. On the other hand, consider Cooper, age 34, who invests $2,000 annually over 30 years into his 401k. At age 65, Cooper, who has invested 3 times as much as Madison, will have $328,988 in his retirement account. In this example, Madison, who began investing early and gave her money time to earn compound interest, has $225,000 more than Cooper to spend during her retirement. 3. Your spending habits will improve. Investing early allows you to develop disciplined spending habits by focusing on your budget and cutting expenses when needed. The goal here is to earn money by saving money. This is impossible with poor spending habits and a life full of impulse buying. Through early investment, the lessons learned will pay off in the long run, especially when you have even more capital to work with and restraint is needed. 4. Be a step ahead of everyone else. The early bird gets the worm is an idiom worth adhering to. The earlier you begin investing, the better your personal financial situation will be down the line. Compared to your counterparts, who may have chosen to invest later in life, over time you will be able to afford things that others can't. Additionally, at some point your finances may become unstable, but by investing early you'll be prepared to face such hardships. 5. Your quality of life will improve. People who invest in retirement plans such as a thrift savings plan, 401k, or Roth IRA are taking steps toward an improved quality of life. Early investment will reduce the risk that you'll be forced to make reckless choices to secure a stable retirement.
In most cases, the best way to begin investing is to decide which asset classes you want to own. There are three major ones to choose from: real estate, stocks, and fixed income, bonds. Each has its own risks, opportunities, and tax rules. While building a complete portfolio might seem complex, the dividends, interest, and rents can be worth it. You will tend to lean toward asset classes based on what you know and need at that time. When your life changes and as you age, your needs change. You'll go from needing growth to needing a stable income. Different types of assets can meet these changing needs. Key takeaways. The three classes of investments are owning a business, stocks, money lending, bonds and loans, and real estate. Buying stocks is one of the most common ways people start investing. Buying a home and renting it is one way you can break into the real estate market. Loaning money with terms as the New York Stock Exchange, NYSE. You can invest through your broker, 401k plan, individual retirement account, IRA, direct stock purchase plans, or mutual fund accounts. Start your own company. You can start your own business and form it in one of many different ways. If you have the talent, skill, and drive, starting your own business is often more profitable than buying a stock. Buy into someone else's privately held company. You could become a partner or buy into a private company. There are several ways to do that, such as using cash, offering your labor, or negotiating some terms. Some investors focus on private equity and restrict themselves to sectors of the market where they feel that they have an advantage. Lending your savings. Money lending is as old as civilization. You save up as much as you can and start making loans to others. You ask for interest on the loan, based on its risk and term length. Bonds are also a form of money lending, but you're lending to a business. You lend them money, and they pay a coupon, interest, rate and give you your money back at the end of the term. Purchase bonds. Bonds are debt issued by governments, such as treasury bonds or savings bonds, or businesses. They can also be issued by municipalities, corporations, nonprofits, or other entities. You can buy bonds and bond funds through a broker. Make a loan. You can make a direct loan by privately negotiating with someone who needs money. You might use a written or verbal contract that details the terms, conditions, a repayment schedule, and the interest rate. The compound yearly growth rate you can earn when lending money depends on your skill with interest rates and payment schedules. A certificate of deposit, CD, is money you give to a bank or other financial institution. When you place your money in one, the bank pays you interest in exchange for the loan. It's best to use money you won't need, because you won't have access to it before it matures without paying a penalty fee. Once it matures, you get your money back. Investing money in real estate. Behind lending money, owning real estate is among the oldest financial money-making activities. If you own land or a house, you can make money by renting it to someone. Purchase a home. Buying a home for your family falls more along the lines of cost reduction than investing. However, home values rise and fall similar to stock. You can buy a house for $100,000 one year and see its value increase to $120,000 the next. That is an increase of $20,000 in equity over 1 year. When evaluating real estate, the cap rate, or capitalization rate, helps you figure out how much profit a property can make. To find the cap rate, a percentage, divide the property's net operating income by its current market value. You can also buy a house to rent it out to families who cannot afford a home loan. A lease purchase contract is an agreement between an owner and buyer. The buyer pays an option fee to secure the right to buy the home at a later date at a set price. The seller leases them the house until they purchase it, hoping to make money on the lease payments and when the home is sold. For example, suppose you bought some homes and rent them out on lease-to-own terms to families who couldn't qualify for a mortgage. After adjusting for various factors such as taxes and maintenance, your cap rate is 13%. That's a much better return than 2% interest for a CD, or the 0.1% offered on savings bonds. 1. Flipping and REITs. Another method of real estate investing is to buy a home, improve it, and then sell it for more. That is called flipping and is very common in real estate. Many people make money on homes by putting money down with other investors to buy real estate through special tax-advantaged businesses that are exempt from corporate taxes, under most circumstances. Businesses that pool money to invest in real estate this way are known as real estate investment trusts, REITs. You can often acquire them like any other stock through a brokerage account. There are even ETFs and mutual funds that specialize in REITs, and you can buy them like any other equity. Frequently asked questions, FAQs. How do you start investing in stocks as a beginner? One of the most common ways to start investing is with a broad index fund that tracks either the S&P 500, NASDAQ, or Dow Jones Industrial Average. These products automatically diversify your brokerage account with dozens, or hundreds, of the most successful stocks in the U.S. economy. Many ETFs track broad indexes like these, but highly liquid options for the S&P, NASDAQ, and Dow include SPY, QQQ, and DI, respectively. Of course, these are relatively low volatility investments, and some investors will prefer the high risk-reward ratio of individual growth stocks or penny stocks, but the stability and popularity of these indexes make them good for learning about how markets work. What is the best investing app for beginners? There is no shortage of investing apps to choose from, but you must find one that meets your needs. If you're looking for an automated investing app for beginners, then Acorns or Betterment might be good choices. If you're looking for a more traditional brokerage, then TD Ameritrade or Fidelity apps may be worth exploring.